Well, I welcome you in my class, Financial Engineering. And first, let me start with an overview with the main topics we are talking about in this class. And then, in a couple of minutes, we immediately start with the contents. So this class, Financial Engineering, is divided in two parts. The first part is about how can we develop financial products based on options. We will see that option is a financial derivative, is a special product we will concentrate on, and I will explain everything, how an option works, what are the properties. We will see there are different types of options, put and call, and there are short positions of an option and long position of an option. So we will learn everything regarding options. And then the question is, if you are working in a business and you are exposed to a certain risk, exchange rate risks, or interest rate risks, or oil price risks, and you want to hedge the risk with a certain profile, with certain price ranges and so on, how can I design my own product that is hedging this risk based on financial options? And this is done what we call in financial engineering. And the first part of this class is just about getting an understanding about what is an option and how can we design new financial products based on options. In the second part of the class, we concentrate then on the pricing. So the question is, if I design this product, then I need an option, right? I have to buy an option in the market. So what is the fair price of an option? And to get the price, we will see Black-Scholes, which is the formula that helps us to find the fair price of an option. And that is what we will tackle in the second part of this class, to calculate, to compute the price of options. And if we're able to find the price of one option, obviously we can find the price of complex financial products which are based on options. But to do the pricing in the second part, obviously we have to learn a little bit about complex mathematical things, like how can I model an asset price process, a stock market? How can I handle this with mathematical equations? And that leads us to a field what is called stochastics. And we will talk about stochastic processes. And by this we can model stochastic behavior, stock price, an asset or whatsoever, an interest rate, an exchange rate. And this is needed in the end to do the pricing, to tackle the pricing process of options in the Black-Scholes formula. So we'll see, we start with engineering. Then we learn the toolkit we need to tackle in the second part, the pricing. So this is a big picture we are doing here in this class. And I also have a kind of outline here, which once again is showing you what I already mentioned. So what we will do in the first, let's say, 2 to 3 weeks is 1 and 2. One is, I give you the idea what is an option, what are the properties, that you know a little bit about this category. Then we move on to the engineering aspect. So what can we do with options, different types of options, using this for hedging, design of new products. Then in sections 3 and 4, we learn the tools we need for the final goal, the ultimate goal of this class, pricing these financial products, in particular pricing options. In general, we call this financial derivatives. You will see in a second why we call it a derivative. That leads us to Black-Scholes. Then we discuss extension of Black-Scholes. And then more complex options are called exotic options. So this is the outline of this class, what we are doing over the next 10 weeks or so. So now let me start immediately with the first part, with the introduction to option theory. So this is my outline for today. We first start with a history of option markets, so very smooth start, no math and anything, right? Then we talk about the payoff function of options to get an understanding what is an option, how does an option work. Then we move on the engineering aspect, designing new products. And then before we do this, there is a kind of break for a couple of weeks where we learn the mathematical skills, which is not explicitly here in this overview outline. Okay, so let's start with the first part, the history of option markets. Well, the first options, you will see that is a very recent development. So it's not an old market like the stock market, which exists since more than 100 years or so. The first options were traded in Chicago at the Chicago Board of Option Exchange. Yeah, and it all started in the 1970s. And in the beginning, they just traded what we call call options. I explain this in a minute, what a call option is. And then after some time, they also extended the trade and included so-called put options. And in the beginning, there were just a few options. Today, if you look to the Chicago Board of Option Exchange or some other exchange, by the way, in Germany, the special option exchange is not in Frankfurt, it's in Stuttgart. Yeah? We have thousands, I would say even millions of different types of options. And you will see in a second why we have such a huge variety of options. Most of the trade is not done on the exchange. Yeah? Most of the trade is done what we call over-the-counter. And over-the-counter is a kind of telephone or internet network. That means, well, there's a bank A and a bank B, and there's a trade in bank A and bank B, and then the guy in bank A says, well, I have a certain product, maybe engineered, my own, and I want to sell. And I call the other guy, do you need something like this? And he is calling then the guy in bank B, and bank B say, well, yeah, that's what we need, I buy. Yeah? So that is what we call over-the-counter. And most of the option trades are over-the-counter network. This has a reason, obviously. The reason is that if there are option trades on the exchange, they are more standardized. Yeah, if you trade a product over the official exchange in Chicago or at any other place, you have to fulfill certain requirements. And the option trade over the counter is somehow more chaotic. Yeah? You can really design crazy products which just fits the property of one customer you have, yeah? Which is obviously there is no other demand. So there's no demand in this economy or around the world, just it's for this customer, and obviously that is then just traded over the counter. And so the products are usually more complex. You have the possibility of design very special products with certain properties, and the properties are not standardized. All the products which are traded over the exchange are more standardized in terms of pricing ranges, timing, maturity. You will learn this in a minute as well, what I mean by this. So the advantage of over-the-counter is that the contracts are more flexible. The disadvantage, higher complexity, and nobody understands in the end or understood what we did. One reason why we had these troubles during the financial crisis. So now let me define a derivative. What is a derivative product? And an option is a derivative product. Derivative means, or a derivative product can be defined as a financial instrument whose value depends on something else, a derivative, an asset behind. Yeah? So the value of an option is a financial product that the true value of this option is dependent on something behind the option. For instance, you can have an option on a stock, for instance, Microsoft stock. You can have an option, and what is behind is an interest rate. You can have an option on an index like the Dow Jones. So a derivative product is always dependent or reliant on something else behind. And that is a derivative. Yeah? It depends on something. It depends on, it's derived from, the value is derived from this underlying, what we call an underlying, variable or asset. So whenever we have a product that is dependent on something else, we call it a derivative product. An option is the best example of a financial derivative. In general, there are different derivative products. They are so-called forward and future contracts. These are also derivatives. You can have a forward or a future contract on something behind, oil price. a stock, an interest rate, an exchange rate, like for options. But we will see that forwards and futures, they are somehow linked to options, by the way, but they have a different feature. And in the end, it turns out, if you really got the idea, that the option contract is, I would say, contains all the other derivatives. Yeah? So with this, with an option, you can design what a forward or a future contract can, what a swap can, and yeah, well, these are extensions of options, what we call exotic options. So the option is the most general derivative product in simple words. And due to the fact, when we understand the most general very well, then we can understand everything that is easier. And therefore, we study and concentrate here on options. Yeah, so we will not discuss forwards and futures. I will just mention this in the beginning to tell you a little bit next the difference. The difference between a forward and a future, same feature, but future is standardized, usually traded over an exchange, and a forward, same structure as a future, but a forward is an unstandardized contract, yeah, which is traded over the counter, higher flexibility, certain dependent on the property you need. So first we start with what we call plain vanilla options. That's what I do next. I explain how an option works and the different types of options. And then towards the end, we will also talk about what we call exotic options. But we will see we are happy if we are able to really understand the pricing and Black-Scholes of plain vanilla options, because even the pricing for these standard option products is quite difficult for an undergraduate student, obviously. Okay, so now let me continue. Okay, question?
You just mentioned that option is the best example of derivative.
Yeah.
But at the same time, you also said that option is the basis of everything else that you just mentioned. So which one is the bigger?
No, so the question is, you ask for, well, is really option the kind of generalized class of a derivative product? I would say yes, the option is the best example of a derivative, and it contains implicitly the idea of a future or forward contract. So if you understand the technique or the mechanism of an option, to understand a forward or a future contract is easy, because option contracts are more general. Yeah, that's the general class of a derivative. Yeah, so it's a class, and then you have derivative products like future and forwards or something else, which are special features of this general class. And due to that, we study options because this is a general. If we understand the general, then we understand everything inside the box. So second section we will do now, let's see what are different types of options and what are the mechanisms of a financial option. First of all, I will start with terminology, some definitions. That is wording, yeah, terminology I need later on. And it's good to learn this as soon as possible, that you know all the terminology I introduced today next time by heart, because otherwise you are lost relatively soon. Yeah, it's special finance language, but I will use and I will need this wording. So first we distinguish between what we call a call option and a put option. So what is the definition of a call option? The call option gives the holder, so when I buy a call option, then I'm the holder, the right to buy an underlying, yeah, this is the asset which is behind my option, to buy an underlying in future at a certain price. And in this option contract, so we make a contract and we specify a price, so I have the right, I'm the holder, to buy the underlying. Suppose the underlying is a stock, Microsoft stock. Then when I have a call option that gives me the right to buy the Microsoft stock, let's say next year on April 10th, at a specified price, let's say $100. That is what we call a call option. I have the right then to buy the Microsoft stock next year at April 10th, the Microsoft stock at 100. Suppose Microsoft next year is at 200, it's a great deal because I have the right to buy it at 100, I sell it immediately in the market at 200, 100 euros profit. That is the mechanism of a call option. You will see in a second I make a payoff function and then we illustrate this profit and loss property of options. But the call option, the key feature of a call option, it gives you the right to buy the underlying asset. And that differentiates a put option. A put option is the right to sell the underlying asset, to sell Microsoft stock at a certain time, at a certain price in future. And the time and the price is always specified in the contract. So keep in mind, a call option gives you the right to buy an underlying asset in future at a certain price. A put option gives you the right to sell an underlying asset at a certain price in future. Question?
When you say it only gives you the right, it means you don't have to sell or buy at that time. If you don't want, you don't sell it or buy it. Right?
Okay, the question is, you only have the right to sell? Yes, you can use the right or you can don't use. We call this exercise the contract or don't exercise. If I go back to my example, call option on Microsoft, I have the right to buy Microsoft next year at 100. Suppose the stock price of Microsoft next year is 80. Well, then I don't use this call option because I can buy Microsoft in the market for 80. Why should I use my option, exercise my option, and buy it for 100? Does not make any sense. So I don't exercise, and if I want, I buy it in the market. So the option is a right, and you can choose at that point of time whether you exercise the option, the right you have, or you don't. And that is obviously dependent on the price of the underlying at that point of time. Right. The difference, so the question is, what is the difference of the option and a future contract? In case of a future contract, which I also mentioned as a derivative product, you must do it. You must buy Microsoft, or if you have in future an oil price. Yeah? There is no right and possibility to say, well, I don't exercise, I don't want to buy. Well, you have to do it. A future, it's a must. In option, you have the right, and you can decide whether you buy or don't. And there's another difference. Most of the, not most, but some of the future contracts are also explicitly linked to the physical delivery. Yeah? If you have a future on oil, then there is a truck coming to you and bringing you this barrel of oil. Yeah? Most of the option contracts are linked maybe to oil, but it's just financial contract. Yeah? There's no truck is coming to you and brings you this barrel of oil. It's just money flows around, and then you can buy it if you want to have the underlying.
I have the question in case of a put option. If let's say the stock is at price, the market price is 80, but you have the right to sell it at 100. Who is buying it for 100 if they can buy it for 80? Like how is someone made to buy it, or how?
Yeah. So I will not answer the question now because I will explain this in a second. Okay. So there are two sides. Yeah? So wait for a second. In general, we have two positions of options. I can buy an option, and that is called a long position. Yeah. In simple words, the finance guy just say, I'm long in an option. That means I buy an option. And obviously, I can buy a call option. I can be long in a call option, and I can buy a put option. I can be long in a put option. But I can also, if I have now a portfolio, I can also sell my call option or my put option. And that is what we call short. Yeah, so I'm short in a call option. That means I sell my option, which I have, to someone else, or I sell my put option. And that tells you immediately there's always another side. If I have a long position, if I buy a call option, there's another guy who sells the option. And therefore there's always another guy, if you exercise the option, who is buying the underlying asset. And given these 4 terms, we can now design and plot graphs of options. We can first plot how does the payoff function of a call option, a long position, looks like when I buy an option. And I can plot a curve how a call option looks like when I sell a call option. And I can do the same for a put option. So basically we have now 4 possibilities. Yeah? I'm long in a call or short in a call, I'm long in a put or short in a put. And that is what I will do next, and I will introduce this by so-called payoff functions to get a better insight. Before we do this, I need further terminology. That's my second slide.
Sorry, just a question regarding the previous thing. You said that there are always 2 sides, long
Yeah.
and short.
Yeah.
If it's not OTC market, there may not necessarily be an counterpart. It could be just stock, like what is it, like stock exchange. It's not individual person who's trading.
No, even in the question is, are there always 2 sides of the market? Yes, even. So if OTC, well, one guy phones the other guy, then it's obvious. And on the stock market, there's always a clearinghouse who has to match supply and demand. So even in the stock market, it only works if there are 2 sides. And there's only a money flow or a product flow if you find one side of this and one person of this side. So that's a guarantee which is always needed in finance. Otherwise,
Just talking about investors.
yeah.
When we say there are both sides.
Sorry?
We are not only talking about investors themselves when we say there are both sides. There are
Yeah.
clearinghouses and banks.
Right. Okay, now let me follow with the next terminology we need to get a better understanding of options, put and call, long and short positions. First of all, there is a price, right? We specify what I already mentioned in this option contract. And this price has a special name. We call it either exercise price or strike price. That are the $100 I mentioned. I have a contract of Microsoft to buy Microsoft in a year at 100. These hundreds are called the strike price or the exercise price. Then this contract has a time to maturity, yeah, until next year. That is what we call the maturity or the final date, the expiration date. Yeah, on 10th of April. It's the expiration date. And then we also distinguish between what we call American options and European options. It has nothing to do with Europe and America. A European option can just be exercised at the end of maturity, at April 10th next year, in my example. So I buy it today, and then I hold this, well, I can sell the contract to someone else, but the exercise of this option is only at the end, April 10th next year. That is what we call a European option. An American option, however, can be exercised at any time. Yeah? That means I buy the option contract, and then I see, well, the price of Microsoft increases. I have the right to buy Microsoft at 100 in my option. Yeah, and suppose now there's a kind of peak. It increases to 200, and I expect then until next year it goes down. Well, if I have an American type of option, then I can exercise it immediately at that time, when I feel it's the best time. Yeah? So American options give you additional flexibility to exercise at any time I feel it's a good time to exercise the option. And this additional flexibility obviously increases the complexity, in particular when we talk about pricing, yeah, where we are heading in the second part of this class. So most of the pricing in Black-Scholes, and you will see even that is quite hard, is first just concentrating on European option types. An American option, you can say, is already a kind of exotic option. This is more difficult than the standard European option type. And therefore, the European option type, just exercised at the end, is what we call the plain vanilla option, the simplest form of an option. And any deviation from this simple option type is called exotic options. Yeah? And then we will see there are special, like the last bullet point is telling you, special specifications, and towards the end we will really have one class where I tell you a couple of examples of exotic options. It gets really complex, really funny and interesting on the other side, but first we concentrate on European options, yeah, for the next weeks. American options are not in our focus.
This might sound a little bit stupid, but is it allowed for European banks or in European soil that you can buy American options?
Yeah, everyone.
So it has nothing to do with regulatory requirements or stuff.
Right. So everyone can buy European option, American options. So the wording, I have never really studied the history of the wording. Has just to do with the property exercise only at the end. European exercise at any time is called an American option. And you can buy all the different types at any place in the world.
Which one is more common?
Well, you know, most of this field likes to have high complexity, and therefore I think American options are quite common because they offer you additional complexity, but it's difficult to answer. There are most of the options traded on the exchange because they are more standardized, are more likely European options. Yeah, but you can also trade on the exchange American options there also. So it's difficult to say. But what I can say is the following: due to the fact that American options provide you an additional degree of flexibility, they are more expensive. Yeah, they give you more flexibility, and therefore, obviously, you have to pay for this flexibility. So the price, if you have the same call option on the same underlying, American type is then more expensive than the European type. That is for sure. And we will later on see this when we do the pricing.
So yeah, my question is, I mean, considering these limitations about these European options, and why do I go for European options? I mean, is there any factor that I need to
Yeah.
think of? Because
Okay.
I always go for American because it gives me relaxation.
So the question is, why should we have European options, not just American options? Because American options are more flexible. The simple reason is they are cheaper. And I give you in a second an example. You know, in the end, you know, the economic rationale is to make profits, to have a high rate of return. And if I can buy the underlying with a cheaper investment, well, and I get this with a European contract, I can do the same obviously with American, but I have a higher initial investment if I buy the same underlying with an American because they're more expensive. Well, then I choose the European. Yeah, it has to do with profit maximization. Yeah, they are cheaper. That is the reason why European options have some justification in markets as well.
If you have a European option traded on the regular stock market, you can always sell it to the market price.
Yeah.
So you basically have almost like the same flexibility like an American option.
Well, so the question is, if I trade an option on an exchange, you can always sell and buy these options. Is there any constraint then? Well, it depends. You know, sometimes when we go a little bit ahead and have these engineered products, which are with very special properties, they are not traded on the exchange. Yeah, this is one answer. The other answer is for at the exchange, there are usually just option contracts for certain maturities. Let's say maturity next month, then in 2 months, half a year. If you want to have a contract, let's say after 7 months in 2 weeks, you don't. Yeah, it's and then you see immediately. So there are reasons behind this why we have European and options and American options, and why some people sometimes buy American or a European option. But you are right. So by trading options, selling options in the market, you also have some flexibility with a European option. So keep in mind, in particular, the price in the contract is called the strike price, the time is the maturity, and we distinguish between American and European options, and in the beginning we just discuss European options. That makes all the discussion simple for us, and even then it's not so easy to do. And later on we extend our theory to American options and more exotic options. Well, I already mentioned what is on this slide. The simple option types, European is called plain vanilla, and the Black-Scholes, standard Black-Scholes approach is about European options, plain vanilla options. Later on, we will extend the Black-Scholes framework to exotic options, and obviously here there are different possibilities, what we label then exotic, and I explain this when we are at that point here in class. Now let me come to a very important part, because this is a graphical representation of an option payoff. And that is what you have to know in the end by heart. Yeah? Because it tells everything what I already explained in words is what you can see by this graph. This graph is a call option, and it's even more, it's a long position in a call option. So when I buy a call option, in the end, I will have this graph. So now let me explain this graph in more detail. So first of all, on the horizontal axis, we have the price of the underlying asset, what I call S. In my example I used, this is the stock price of Microsoft. Yeah? Microsoft can be stock price 0 up to infinity. Yeah? So this is here on the horizontal axis, the asset price of my underlying. But keep in mind, when we talk about an option, it's not the underlying can be everything else. It can be an interest rate here. It can be an exchange rate here as the underlying and the level of the exchange rate. It can be an index, yeah, Dow Jones from 0 to infinity. So all underlyings and the value of the underlyings are here on the horizontal axis. So to make it simple, I will just use today this idea of the underlying is an asset, is a stock, let's say Microsoft or Apple or whatsoever. Yeah? So S is the stock price or the price of the underlying in more general. K is the variable we use for the strike price or the exercise price. This is the price we fix in our option contract. Yeah, back to my example. I buy a call option that gives me the right to buy the Microsoft stock in a year at a price of 100. Then the K, the 100 is the strike price. So this would be 100 in my example. And then, suppose now we are logically at the end of maturity, so in a year when the contract expires on April 10th. Then the payoff function, actually, and that is what I explain next, looks like the red curve. Yeah? This is the payoff, call option payoff at capital T. The capital T is always indicating the time at the end of the contract. The lowercase t is today. The capital T indicates the end of the contract. And at the end of my contract, so in a year, the payoff of this option looks like the red curve. So let me explain why it is the red curve. Suppose in a year, the price, the underlying stock price of Microsoft is exactly 100. Then I have the right if I exercise my option to buy Microsoft at 100, but the market price is also 100. So I will make no profit, right? Even if I exercise my option, no profit. And therefore, we are here. On the vertical X, you see this payoff. Positive means profit, negative means loss. Due to the fact when the option price is 100, there is no effect, there's neither a loss nor a profit. We are here at 0. Suppose the stock price in the market in a year is 200. Yeah, it's here somewhere. This is 100, this is my strike price, and the market price is now 200. Well, now I have the right to buy Microsoft stock at 100, but the market price is 200. I sell it a second later in the market at 200, so I make a profit of 100. And that is the difference if you go up from the 200, the current market price, to my red function. And therefore, the slope of this red function is 1. It's a 45-degree line. Yeah? For every unit above 100, if the price in the market is 100, I have the right to buy it at 100. I sell it in the market at 100. I make €1 or $1 profit. Yeah? 1 unit to the right, 100. 1 unit up. Slope of this line is 1. So it's 1 or 45-degree line. And that line reflects the payoff at the end of maturity for European call option. What happens on the other side? Well, you see immediately on the other side is always 0. Why? Think about it. I have the right to buy it at 100, but in the market the price in a year is then, think about, let's say it's 50. Well, it's not a good deal, right? If I exercise my option, I can buy Microsoft at 100, but why should I do this when I can buy Microsoft in the market at 50? So what I do in such a situation when the market price is on the left of my strike price, I don't exercise. I say, well, I don't exercise. And if I want to buy the stock, I buy this directly in the market. So I have no payoffs. No payoffs. But obviously, you have a loss. Because when I buy the option contract today, I have to pay some price for this option contract. That gives me the right. If I'm on the upside, if the stock price is high, I exercise. To have this right, yeah, that costs some euros. If the stock price is really then on this side, well, this initial investment is a good investment because there's a huge leverage. I will give you an example with numbers in a second. But if you are here on this side, you have lost 100% of your initial investment. And that is a risk. Yeah? So we have to distinguish between a payoff function here and a profit function. A profit function includes the cost, the initial investment. And if I take into account the initial investment, obviously what I have to do, I just have to shift the red line down. And then it looks like this and goes up like this. Anything on the left of K, I have the loss of my initial investment. And anything on the right on K, I have a profit, but I have to subtract obviously also the initial investment. Yeah? And there's a kind of break-even point then here when the stock price of the underlying at the end is larger than a certain value, bigger than K, I make profits. Because logically I have to subtract the initial investment. So we distinguish between payoff function is here and profit function. Profit function is just shifted down, so you have to subtract the initial investment costs. So the red curve, again, is representing the payoff of a call option, a long position of a call option at the end of maturity.
Without the costs.
Yeah, well, because it is a payoff function. Wait a second. So if I write profit here, stock price on the underlying. Here's my strike price K. The corresponding profit function would look like this. Let's say I have to pay for this option contract 10 euros. Yeah? That is then the loss I have if I don't exercise. And then you know the slope here is 1. So as long as I make then a profit of 100 and the underlying at the end is more than 110, I am above a kind of break-even point, you can say, and I really make profits. The payoff is already positive on the right of K. But you know profit is revenue minus cost. Yeah? And revenue is another word we use here for payoff. Minche?
Yeah, so the x-axis is static. It's not. It's priced at a time. It's not the timeline.
It's not the timeline. It's the value of this, let's say, Microsoft stock. And I don't know what the Microsoft stock is in a year, right? It could be 200, it could be 50, it could be 0 because Microsoft is gone. It could be 1 million. It could be everything. This, in the end, is a stochastic variable. I don't know. And if we want to know and to calculate what is the fair value to invest in such a product that gives you some return in the future, well, you have to model this stochastic variable. And that leads us then in the second part of this class to the pricing. So this is, again, a profit diagram. Profit diagram. And this on the screen is the payoff. Very important, yeah, to distinguish these two. Profit includes initial investment. Payoff is just the payoff. So, that's good. Now we distinguish certain areas. If we are on the right-hand side of K, we call it the option is in money. On the left-hand side, the option is out of money. And if the price of the underlying is exactly the same as K, we call the option is at money. It's just terminology. Next, I can describe the red curve in mathematics, which is here in the yellow box on the bottom. C is the value of a call option, and this is obviously dependent on the price of the underlying, yeah, the Microsoft, what is Microsoft in a year, and the time to maturity. And what is the value at the end? Well, if the stock price in a year is greater than my strike price, yeah, if the stock price in the market is 200 and I have the right to buy it at my K100, well, then I exercise. Then this is positive, and I choose the maximum. If this is negative because the price in the market is less than my strike price, it's 50, yeah, and I have the right to buy it at 100, and then you see this is negative, the first element, but I always choose the maximum, well, then it's better, don't exercise, 0 payoff. So this function, this maximum function, st minus k, or 0, is actually graphically represented by the red curve. This is the mathematical expression for the red line. Don't exercise if st is less than k. If the stock price at the end is greater than k, you exercise, and the payoff is actually the difference of stock price in the market minus strike price. So you choose the maximum. The problem is, always write max in front, 3 letters, and therefore we have a short writing with a plus in the exponent, and this is just, we choose the maximum. Yeah? If this is positive, we exercise, and that's then the payoff. If this is negative, don't exercise 0. So this plus, in the end, indicates a maximum function. It's a short writing of the first, and this is obviously only positive, yeah, and exercised if st is greater, equal, or greater than the strike price k. So this is the mathematical representation of my red curve. Next, you see a plague curve in this diagram. This is the payoff curve of a call option, of this long call option, before maturity, before capital T. So this is maybe the payoff of the call option today. And well, first of all, you see this is a continuous curve. It's not linear like the red curve. And in the end, if I know this black curve, then I know the price of the call option today. But to find this curve, we have to study 10 weeks until we have Black-Scholes to understand where does this curve come from and what is the price of this curve. And by the way, so if we understand these payoff properties, and particularly this payoff function, you see there are two special areas of the red curve. There's a linear part, and there's this horizontal part. So it's not just a line, yeah, like this. There's two segments. And due to this, we call this a kind of, you know, a separation. There are two areas. And due to the fact we have these two areas, we have the right to exercise or don't exercise, we have this additional degree of complexity, and that is differentiating futures. A future contract looks differently. That looks like just a line. If the price is up, you have to exercise, you make a profit. If the price is low, you have to exercise it anyway, then you have the loss. Yeah? You don't have this horizontal segment. So if we understand the more general class of options, you see, this is more complex than a forward contract, which is just a line, a linear function, payoff function. Yeah, and therefore, I mentioned at the beginning, we mainly concentrate on options because that is the most general class of derivatives, and if we get an understanding of these, we have an easy way to understand any other derivative like forwards and futures. Well, yeah, you can price virtually any financial product under the sun if you understand how to price an option. Yeah? This is the most complex derivative category in a way. Then you see these two wordings. Well, the difference between the red is called the intrinsic value. That's a true profit or loss, you can say. And then we also have a time value, which is between the pricing curve, the black curve today, and the payoff curve at the end. That's what we call the time value. The time value will change over time, obviously. And the closer we are moving to the maturity, to the expiration day at the end of my contract, the closer the black curve gets asymptotic to the red payoff function. Yeah? Day after day, week after week, the black curve moves down, and then at the end of maturity, it's the red one. Yeah? When we are very far away, the black curve is very high above this red curve. That's what we call the time value.
Is this because the underlying asset has a higher probability or has more time to change its value when there's more time to maturity? Because when it's just before the expiration date, then the underlying asset might not have the time, or there might not be special events that may have a special effect on the stock price, this underlying asset.
Mm-hmm. So the question is, what is behind the time value? Well, we will tackle this question over this semester. It's not an easy answer because it has to do with the pricing of an option. You have to think about, well, what is the fair value of an option that gives you the right to buy Microsoft at 100? That depends on a lot of parameters. It depends what is the price in the future, and then you have to think about what determines the price of the future. Yeah? All the variables that have an impact on the asset price in future depends the current price of an option. And the time value is basically reflecting that when I'm very close, when maturity is tomorrow, well, then probably the stock market price cannot really, let's say the market price is then close to 100, maybe it's 110 or 90, but it will not jump within a day to 10,000 or 0. So the range limits as closer as we get to the expiration date, and therefore we converge to this red curve. When we are long away, in a year, it's possible that Microsoft is not, or Apple is not here in a year. So the uncertainty is far higher on the downside as on the upside. And that is reflected by this time value parameter. So you will get a better understanding over the time, over the course, when we move to the pricing.
Is the time value for a very volatile asset also different? Because this would have, even at the end, a higher chance to get, or a higher probability to get close to the, because it is more volatile, that it is jumping up and down more even at the end, whereas a not so much volatile asset doesn't have the chance anymore?
Yeah, absolutely. The question is, does the time value also depend on volatility of the underlying asset? Yes, we will see this. I have a list and show you just some parameters that determine the value of an option, and so the time value. And volatility is one parameter. The higher the volatility, the higher is the range of the underlying asset down as upside, and obviously makes an option more valuable. And that is reflected then in a higher time value. Absolutely. Correct, yeah.
You mentioned that the time value is determined by parameters of the underlying asset, but isn't it also possible that demand plays a role? Because when no one really likes the option, maybe because of its structure, the price might fall as well, and it's not dependent on the underlying asset.
Well, I would say the price, so the market price of an option, once again, is determined by supply and demand. But we have products, option products, where there is just one supply and one demand. So there is no price finding process like in a stock exchange. And due to this counterexample, you see supply and demand cannot be really decisive in this respect. So there are these other parameters that matter most. Okay.
Can we go back to, could you just explain once more why it's 45 degrees between, why is the slope 1?
Okay, the question is, why does the red curve slopes up with 1 or 45 degree on the right of k? Think about following. So it's best to take the example. So we have payoff, underlying asset, and we say the strike price is 100. And then we already know, well, I just have this blue at the moment. The payoff function looks like this, and the question is, why does it slope up with 100? Suppose at the end of maturity, the price in the market at the stock exchange is 110. So you know this, on the horizontal, on the x-axis, we have the price of the underlying. Here's 100, 110, 120, and so on.
Sorry, the first one?
This is K. This is my strike price.
100, okay.
Is 100. And then, at the end of maturity, we compare my contract. I think about, should I exercise or not? And I look to the market price of the underlying, and I see the price of Microsoft in the market is traded at the moment at 110. So, now, if I have this option, that gives me the right to buy Microsoft from my counterpart at 100. If I have then the Microsoft, I sell it in the market at the stock exchange at the market price at 110. So I make the difference, the delta, 10 profits. 10 profits. And this is, this is the payoff. So this difference here at 110 should be 10. If the slope, if the delta 10 is here, and I make 10 profits because I buy it for 100, I sell it in the market for 110, I make a payoff of 10 positive. Well, you see, 10, 10, slope is 1. It's a 45-degree line. If the stock price in the market is 200, the delta is 100 here, and I make a payoff of 100. So this line has slope 1. Right? Okay. That's always. Well, if we have two options, then it's twice. Then the slope is 2. Right? Because if I have two call options for the same, I make profit not of 10, I make profit of 20. And then the slope is 2. 10 for the second option. But for one option, slope is 1.
I don't really understand the black line. Maybe we'll talk about.
Oh well, okay. So now let me continue and do the same what we have here for the call option for a put option. And that is this. This is how the payoff function looks for a put option. Let me remind you, the put option gives you the right to sell the underlying asset in future at a certain price. The red curve is a payoff at the end of maturity. Once again, we have these terminology. At the horizontal x is the price of the underlying. Positive payoff or profit, it's a payoff, positive or negative, can either be positive or negative. And now, when do we have a positive payoff for a put option? It's a right to sell. I have the right to sell Microsoft at 100. Well, if the price in a year of the Microsoft in the market is 50, I make profits. Yeah? So if the price is just 50, because I have the right to sell it at 100, and the market price is just 50, great. So what I do, basically, or physically what you do, you buy it at the market, 50, sell it at 100, and you make 50 euros profit. And therefore, you see, then we are here on the top, the slope is 1. Here it's negative 1 because it's downward, but it's 1. You make profits for a put option if the stock price is less than K. But if the stock price at the end is on the right-hand side of K, suppose it is 200. I have the right to sell it at 100. Well, I will not exercise, because if I can sell the stock at 200, well, I will sell it in the market directly. I will not sell it with my contract at 100, I will sell it in the market for 200, which is even better than 100. Obviously, 2 is more than 1. Or 200 is more than 100. And therefore, I don't exercise my put contract in this range, and we have this horizontal segment. So this is how the payoff function looks like for a put option. Then the option is in money of a put option on the left side, out of money on the right hand side, at money at K. Once again, we have intrinsic value, time value, and you see the time value. This is a function we get from Black-Scholes. This black curve is what we are heading to over time. On the bottom, you see the mathematical formula. Now, we choose the maximum of K, strike price, minus asset price or price of the underlying at the time to maturity. If my strike price is 100, so I have the right to sell it at 100, and the price in the market is 50, I exercise, then I have 100 minus 50, 50 euros profit. If the stock price in case of a put option is 200, I have the right to sell it at 100. Well, I will not sell it at 100, I sell it at 200, because this is negative, I don't exercise, 0 payoff, and you sell it in the market. And once again, instead of max, we use the writing with plus in the exponent. Question?
So when we're talking about a long put, it means that we own this option right now, or how does that mean? Because long is
Buy.
buy. Yeah.
I buy this option and I have it in my portfolio.
Exactly. And now we're talking about once we bought it, what happens when we sell it. Right?
Yeah, and short means I have this, let's say, in my option in my portfolio, and I sell it to someone else. The problem is, you can in finance you can even sell something you don't have it. That's what we call a short sell. Makes it difficult to understand, but that is possible to do. Yeah, we can sell something which we don't have. That is what we call a short sell. But for the meantime, I'm happy with if you got the idea of the payoff function of a call, and long put. Okay, there was one question from a student regarding this black curve. So how can I graphically illustrate this black curve also in another way? And there is obviously a possibility. I can illustrate this in another way, in a three-dimensional way. And then this curve looks like this. So once again, what we have here is the price of the underlying, S. Then we have on this X now time to maturity. This is today, and this is at the end of maturity. Yeah, let's say after 3 years. And then on this we have once again the payoff. Yeah? So and now you see the following. I will rotate this a little bit to give you some impression. If we just look to this curve from the side, you can really see the horizontal segment. Somewhere here is the strike price and this slope one up. If we so the price at this level of the strike price today obviously is positive. Yeah, you see that it's not here on the bottom, it's positive, and that's the initial investment. If the stock price, let's say, is around 50 today, that gives you then, this surface gives you the price of the option. So if we turn it once around, we can see this, yeah, at the price of around 50, we see we are somewhere here, which gives you a positive value in a three-dimensional framework. So this function is also this is a put function. It's a payoff function of a put function, and it's basically the plot of the solution of Black-Scholes. So Black-Scholes in the end you see is a multi-dimensional solution, a multi-dimensional function, and in 3 dimensions, stock price, time to maturity, and payoff, it looks like this. At the end of maturity, it's the linear curve. Before, you see it's here a little bit above. It's not down here. Yeah, it costs something. And if I have a put function that gives me, let's say, the current price of the option in the market is, let's say, 10. It's very small. And here I have an option, a put option that gives me the right to sell it at 50. Well, if the current price is already 10, the likelihood that this option is in money is very high because the current price is already very high. So if I assume the price is an average, so it remains around 10 over the next time, and therefore, you see, if the current price is already high, the price I have to pay is a high amount. But if the price of the option today is 1,500, then the likelihood that at the end of maturity it's below 50, my strike price is very unlikely, because it has to decline from 1,500 to below 50, that this option is in money and I exercise the option. Therefore, the price is virtually 0. So most of the options that are out of the money, and they are very cheap. They cost a few euros or cents sometimes only. And so in a more general sense, this is these black curves, are the curves at some time to maturity. Let's say at 2, and that is a smooth downward sloping curve. If I cut at some time to maturity, it's not this kinky curve, it's a smooth downward sloping curve that comes from this graph. So what, in the end, what we are heading to is to get a formula that describes this surface. Black-Scholes. So back to this. Now I want to give you a kind of an example with numbers to show you the appealing parts about options and the risky part of options. And what I do is basically I distinguish an option investment to a pure stock investment. Suppose the option is reliant on a stock, you know? We have an option on an underlying stock, but instead of having an option contract on a stock, I can maybe also buy directly the stock. Why should I have an option contract? Yeah? So I will distinguish a standard option investment. I buy Microsoft in my portfolio or sell, or I have an option on Microsoft. So these are the two cases I distinguish, and then I suppose, because I don't know what the future price is at the end, in a year, I distinguish two scenarios. Scenario 1, future price of the underlying is 160. Scenario 2, the stock price is 130. The parameters I know today are the parameters in the top. Today's stock price is 150. Time to maturity, capital T is 1. You can say it's 1 day, 1 month, or 1 year, so that does not matter here. Strike price of my option is 140. That is specified in my contract, if I buy an option. Strike price and the time to maturity. And the cost of this option today at time 0 is 15. Yeah? You can say euros or dollar. So now let's compute the profit of an option in scenario 1 and the stock and in scenario 2, and then we compare these 4 cells obviously, and to make it comparable we have to calculate the percentage of profit or loss in relation to the initial investment. This is the only way to make the 4 cells comparable, because the investment cost for an option, as I said, is far lower than the direct investment of a stock. So to have a fair comparison, we relate the profit or loss to the initial investment, and then we can compare the cells. So let's start with the first scenario. At the end of maturity, stock price is 160. Then we take the formula we have learned from our slide before. It's the max of stock price at the end, 160 minus strike price, which is 140. That gives me a payoff of 20. The profit is payoff minus cost. Costs are 15, gives me really a net profit, a profit of 5. And now to make it comparable with the other cells, I relate the profit, the net profit, to the initial cost. My investment here in this case is 15. So 5 over 15 times 100 to have a percentage number gives you a 33 rate of return, which is a nice rate of return, 33. So it seems to be, if you exercise the option and the stock price is higher than the strike price, strike price was 140 and the stock price at the end is above, so I exercise my option, and the stock price of my option is above the strike price, and I exercise the option, then I have a kind of leverage. That is what we call the leverage, and that is reflected by this high rate of return of 33%. Now let's study the second case. In the second scenario, the stock price at the end of maturity is 130, which is less than my strike price. We know from our payoff function, well, then we don't exercise. But we paid today, a year ago when we are at the end, this initial investment. So we have a loss of 15%. 15 euros or dollars. And then to make it comparable, we do the loss of the profit in relation to my initial investment. Is the loss of 15, initial investment was the 15. Well, you see, that is minus 100. So I lost everything I invested. I have a 100% loss. And now you can see immediately the beauty side. The beauty side of options, if you're on the right side, if the market goes in the direction you speculated on and it works out, you have a huge rate of return, a leveraged rate of return. If you're on the wrong side, because the markets go down and you expected it to go up, well, 100%. Everything is lost. Highly risky. Now let's compare this with the stock. What is the payoff of a stock? Well, I buy the stock today in the market at 150. I sell it in this scenario at 160. So at the end I make a profit of 10 euros. Once again, to make it comparable, I have to relate the 10 to my initial investment, the 150 today. So the rate of return in this case is just 7%. You see, if I invest directly in the stock, not with an option, the rate of return is less if we are in the right direction. So you can amplify the rate of return by doing the same if the stock price moves in this direction with an option. What happens in case 2 scenario? Well, once again, you buy the option today at 150, but in a year the option price is 130. So you have 130 minus the 150, you make a loss of 20. But the loss of 20 in relation to your initial investment, the 150 of today, gives you just a minus 13.3%. So well, you lose if the stock price is below your initial when you bought the stock, but the percentage loss is obviously less in comparison to the option. In the option you lose the full initial investment, highly risky. Here you lose just relative to your initial investment, which is in percentage comparable to the option less. So you see immediately the appealing part. It's this kind of leverage effect you obtain if you're on the right side, but when you're on the wrong side, you lose everything. So that gives you an impression about the payoff of an option, when it works out, when it won't, and in comparison to the direct investment of a stock. Using the formulas we already discussed. Now I have here next the list of key variables that have an impact on the option price. And this is just here a kind of overview discussion. In the end, we will see in the Black-Scholes formula, any of these variables pop up. And we have to model these variables. But here, already at the beginning, without knowing Black-Scholes and all the complex mathematical tools we will learn, we can already discuss, just by logical thinking, the relationship between the underlying variables and the option price. We already discussed it when we compared the American option and the European. I said, well, American gives you more flexibility, and for the flexibility you have to pay. The price of an American option is more expensive than the price of a European option. And now let's discuss certain variables. For instance, the stock price. So what the first bullet point tells you is the following. The higher the price of the underlying, the greater is the price you have to pay for this option. I use call option, yeah, C is for call, not P, P is for put. How can we explain this positive relationship? Does anyone have an idea?
Please repeat the question.
The question is, how can we explain this plus sign here that tells you there's a positive relationship between the price of the underlying asset and the price you have to pay for an option today. The higher the price of the underlying asset, the higher is the option price you have to pay. So once again, we use the so-called payoff diagram. Call option, we have a certain strike price, let's say 100. And we know the payoff function is horizontal, and then it slopes up. And now we distinguish two cases. Suppose the stock price today, so let's call it 0 for today, is 50. And then we think about what is the price of an option we are willing to pay in comparison to the situation where the stock price today is, let's say, 150. And what we are willing to pay for an option today. And this relationship is telling us, the greater the price today, I have to pay more. Okay?
When it's 150, the option is already in money.
Yeah?
So the risk is way less
Mm-hmm.
for me as a buyer of the option. But for the counterpart, there's more risk involved. So he wants to have a higher risk premium. And the opposite applies when the price is 50. If it's 50, it must double to reach the
Strike price?
the strike price. Hence, the risk for me as the counterpart for the option is way less, so the price is less.
Right. So let me repeat. So suppose the current stock price is already 150. That means the option is already in money. Even if I don't exercise it today, I have to hold it for, let's say, a month or a year. But given the fact that it's already in money, so it's well above my 100, if I suppose that the stock price is always, moving up and down, but on average it is around this level tomorrow, if I can exercise the option tomorrow, well, the likelihood that this option is in money tomorrow is high, because it's in money today. And therefore, I make profits. The likelihood to make profits, if the current option price, if the current price of the underlying, the current stock price is already very high, the likelihood to make profits with such an option is high, and therefore you have to pay a high price because you have the potential to make high profits. On the other side, if you suppose the price today is 50, then you have to think about first the option price has to increase by 50 to get them positive payoff to exercise the option. And this is less likely, right? If the expiration is tomorrow, to expect that in one day the option price from out of money increased by $50 is quite unlikely. Maybe it can increase in one day by $5 or by 10. But the likelihood, if the current option price is just 50, that it is really at the end above 100 is lower. So the lower the price, the lower the likelihood that this option is exercised and you will get money from this option. And therefore, low asset price today, low price you have to pay for such a contract. If the price is high, it's more likely to make money with this option. You have to pay more for such an option contract. Positive relationship. The higher the price of the underlying, the more you have to pay, because the higher the likelihood that the option is in money, that you exercise, and you get some profit out of this contract.
No, I just wanted to say we kind of always have to relate it to the strike price, though, right? Because if we would just be at any given, so like a stock that has a lower price could still make an option more expensive in case that the strike price is lower than for another option.
Well, the strike price is fixed. That is fixed in my contract. So this is the constant here. And I just study basically the partial derivative. In the end, when we have the Black-Scholes formula, we calculate the partial derivative in respect of the underlying price, we will see it's positive. Yeah, it's just study, keep all the other variables constant. What is the impact on the price of an option if we change the price of the underlying? Okay?
Yeah.
No?
But is it like the rule because of the mathematical formula? Because I think sometimes it can be the other way around. Let's say you expect the price to drop or to increase a lot. Let's say if there is think that there is a bubble and then in 1 year you expect the price to drop dramatically, then probably the price of the, I mean, there's the relationship is
No. No, this has nothing to do. So what I explained here, we have not the Black-Scholes formula. You don't nothing about this so far. In the end, it turns out that our model, which is Black-Scholes, shows that this is right. This is just logical thinking. Has nothing to do with the mathematics. and anything you have in mind is wrong. Move it out. Yeah? Strike price is fixed, and when the current stock price is very high, well above the strike price, then this option already has some value, because the likelihood that you exercise the option, you make profits, is high, and therefore you have to pay more today for this option. So it has nothing to do with what you said with bubble, something like that. No? Okay, it's just reasoning. Wait a second. Maybe it becomes even clearer when we look to the second variable, the strike price. Yeah, we can also study the point, what happens with the option price, yeah, if we plot a payoff diagram, in relation to the strike price. So once again, we have a call option like this, and we have a strike price, let's say first K1, which is 100, and we have another strike price, let's say K2, which is just 50. And then obviously, maybe I make it in dash, you have the payoff function at capital T at the end of maturity would look like this. And now this list is telling you, that's just, I give you the help how to read this. The greater the strike price, the greater the strike price, negative, the lower is the price of the option. That means this negative relationship on the right-hand side. So how can I explain this economically? A negative relationship between the strike price and an option price. The best way, we have to fix a certain price for the underlying asset. So suppose the asset price at the end of maturity is 200. Somewhere here. So this is S capital T. And now we compare these two contracts. Yeah, I mean, yeah.
So you are in money way earlier with the first strike.
Yeah.
So it's less risky for you.
Yeah.
And that's why you have to pay less money.
More, right? If the strike price is very high, the likelihood to make profits is lower, and therefore the option is cheaper. If you buy an option where the strike price is 50, it's highly likely that you make a profit at the end. Therefore, it's very expensive. Low strike price, very expensive. The higher the strike price, obviously, it's less clear whether the option is in money at the end. Less likely to make profits, and therefore the price you have to pay for this contract today is lower. And you see immediately, the larger the strike price, the lower is the price you have to pay today, right? We are talking now about the call option price of my underlying at the small t. That is the price today. It's not, this is the payoff function at the end, right? But we are talking now, what is the relationship of these parameters of the price I have to pay today? And any of these parameters have an impact. For instance, volatility. One student, it was Heike, asked, well, is there also a relationship between volatility and time value? And here you can see positive, obviously, you told us this. The higher the volatility, the more likely is that the option is in money. You are protected on the downside. You don't exercise if you are on the downside, and therefore the options with an underlying asset which is high volatile are more expensive. Positive relationship. Risk-free interest rate is one variable that depends and that affects the option price. Time to maturity, dividends, and so on and so forth. There is a full list, and that gives you already some overview about the pricing issue, what we will discuss in the second part of this class. And you see, there are lots of determinants, parameters that have an impact on the price, and we have to handle this and put this in a model, and obviously, due to the fact that this stock price is stochastic, makes the stuff quite complex, but fortunately, Black and Scholes did it, and we will find a formula that gives us a price of an option, and we can always calculate with this formula the price of a European call option, given the stock price, given the strike price, the time to maturity, and the current stock price, all the variables today, and then we know how a fair price of this option contract is today, even if we don't know what the stock price of the underlying is tomorrow. And that is a crazy thing, but it's possible to do. So,
you just said that the options with high volatility are generally more expensive.
yeah.
But why? Because there is always equal chance for them to go down.
Yes, there's an equal chance to go down and up, but think about this. On the downside, you are protected. You don't exercise. But on the upside, you exercise and have the leverage. And that's the reason. Huh? Next question?
The same question.
Okay. Okay. So these gives you just an insight of what we try to do later on when we move on to pricing. Pricing is, here I just give you an outlook. What we do is we will derive the Black-Scholes formula and we will solve the Black-Scholes formula. The Black-Scholes formula is a second order stochastic partial differential equation, and it looks like this. And we have to solve this to find the price. And in the end, if you have the solution, in the end, you can plug in this solution into an Excel sheet, or you can program an algorithm. You just plug in the numbers. You click on Enter. That is what you do in financial practice, obviously. You plug in what is my strike price, what is the time to maturity, what is the current stock price. Then you click on Enter. And then it tells you what is the price according to Black-Scholes of this option. But we will really look behind this clicking Enter. Right? Even a child can do this, but you are students. You have to know what's going on behind the curtain. And behind the curtain is this pricing formula, and that is what we do in the second part of this class. All the slides are anyway online.
Yeah, but in Relax it's a different formula.
Really? No. Maybe just these coefficients are a little bit mixed, but they are multiplied. You can, commutative law.
Oh, yeah.
It must be the same. Otherwise, in my classes, everything is consistent. Except the typo or so. But then you have to ask and I clarify. But it should be the same.
One question in the previous slide. Why I don't understand the relationship between the option price and the risk-free interest rate.
So once again, we will talk about all these parameters in more detail when we move to pricing. This is just the first insight. I can give you a short answer. It has to do with opportunity cost. Yeah? If you have money, you can use this for investment in an option, or you can put it on your saving account. When the saving account offers you a higher rate of return, obviously you also expect a higher rate of return, which is linked to a higher option price. That is a positive relationship. Explains the positive relationship.